What happens when an entire nation goes bankrupt? While the world is glued to the headlines watching panicked citizens and scrambling politicians, a secretive league of global financial entities is already quietly moving billions. Today, we're peeling back the curtain. We're going to reveal exactly how these titans hedge against sovereign debt defaults, maintaining perfect profitability while entire economies literally crumble around them. I want you to consider the sheer gravity of this statement. They are the ultimate underwriters of human civilization. We aren't talking about standard retail banking here, or your local insurance agent. We're examining the invisible safety net of the world, managed by a highly concentrated handful of global reinsurance giants. When governments face absolute insolvency, this is the hidden architecture that prevents total systemic collapse. Welcome to our explainer on the insurance underworld. Our focus today is the macroeconomic landscape heading into 2026. As extreme climate baselines compound with geoeconomic fragmentation and ballooning public debt, sovereign defaults have really transformed into the critical transmission channel for global systemic risk. We'll explore how these entities operate, how they survive, and ultimately, how they dictate the terms of our global survival.
Let's open File 1, the Reinsurance Underworld.
To understand the mechanics of sovereign survival, we really have to establish the shadowy realm where the world's ultimate systemic risks are traded. This is a stratosphere of finance, where premiums are measured in the billions, right? And the payouts, they dictate the geopolitical stability of entire regions. Witness the hidden hierarchy of global finance. At the base, you've got everyday retail investors. Above them sit the massive institutional banks. Above the banks are the sovereign nations themselves, issuing the debt that funds our societies. But who insures the nations? At the very apex of this structure, the absolute apex predators of finance are the reinsurance giants. They are the final backstop. Look at the undeniable evidence we've pulled together here. This data exposes the massive baseline exposure these entities historically hold. Take Munich Re, Swiss Re, and Hannover Re. Historically, roughly 50% of their fixed income portfolios are anchored directly in sovereign debt. Now, while the dominant bulk is held in highly stable US, UK, and German bonds, they maintain these highly calculated, localized concentrations in peripheral and high-risk debt: Italy, Spain, Greece. What this means is, when a nation's fiscal condition deteriorates, those asset devaluations transmit directly to the capital adequacy of these reinsurers. They're structurally bound to the survival of the state. Moving to File 2, the climate debt doom loop. In the highly volatile macroeconomic environment we're tracking for 2026, extreme climate disasters directly and violently force nations into fiscal crises. Notice the environmental and economic dimensions mapping out here. Pay close attention to those urgent red highlights. That's tracking the extreme vulnerability of least developed countries. As the hazard and exposure index of a country goes up, its probability of sovereign default scales right along with it. These nations face multidimensional risks that can literally strip away their institutional and infrastructure capacity overnight. Trace the chilling sequence of this doom loop with me. Boom, a severe climate disaster strikes, destroying critical infrastructure. Suddenly, the government is forced to dramatically increase emergency borrowing just to fund basic recovery. Because of that, sovereign borrowing costs spike precisely when that capital is needed most. Then, rating agencies instantly downgrade the nation's credit. This creates a vicious cycle that crystallizes into imminent default. The nation is trapped, mathematically frozen from rebuilding. Let's look at File 3, the mathematics of survival. So how exactly do the reinsurance titans survive when the nations they hold debt in begin to collapse? Well, they rely on pure mathematical engineering to decouple their balance sheets from the contagion of national ruin. We have to cite the foundational Bobble assessment here. In the realm of global finance, sovereign default fundamentally violates the canonical principles of risk pooling. According to Bobble, sovereign default fails at least 6 of the 8 core criteria of insurability. It basically proves that traditional insurance models are mathematically impossible to apply to national ruin. The risk is just way too concentrated, the loss is too catastrophic. A totally new mechanism was required. And that solution? The parametric trigger. Let's contrast traditional insurance with parametric triggers. Traditional insurance, as you probably know, is subjective. It's burdened by incredibly slow loss adjustments and endless political negotiations. But sovereign hedging, that operates on parametric triggers. These are automated, algorithmic payouts tied to pure mathematical thresholds. The exact millisecond a nation's GDP hits a negative floor, or a hurricane reaches a predefined wind speed category, the capital just moves.
automatically. There's no emotion, no negotiation, only cold, hard execution.
Let's open File 4, Synthetic Risk Transfers. To further insulate themselves and the global banking sector, financial institutions deploy this incredibly complex weaponry known as synthetic risk transfers. This is the exact architecture used to forcefully dilute and transfer sovereign and bank credit risk across the global capital markets. By definition, a significant risk transfer, or SRT, is a mechanism where a bank transfers the credit risk of a loan portfolio to third-party investors. Specifically, they're offloading the first loss, junior slice of that portfolio. So the banks maintain the relationship with the borrower, but that highly radioactive credit risk, it's offloaded to reinsurers and private credit funds. In return, regulators grant the bank immediate capital relief.
12.5%. I want you to fixate on this critical threshold. In standard U.S. significant risk transfer structures, this represents the standard first loss tranche. It's the 0 to 12.5% slice of losses that private investors and reinsurers actually agree to cover. It is the precise mathematical buffer that stands between a functioning banking system and total insolvency during a severe credit crisis. Now, observe the key distinction between funded and unfunded SRTs. A funded SRT requires the investor to post 100% physical collateral up front. Pretty standard, right? But the European model leverages unfunded SRTs. Here, the sheer capitalization, the strict Solvency II regulatory discipline, and their 99.5% value at risk modeling, meaning they are mathematically stress tested for absolute worst-case scenarios, all of that replaces the need for physical cash collateral. Their balance sheets are so massive, their regulatory oversight so severe, that their mere guarantees serves as the ultimate market collateral. Furthermore, witness the absolute weaponization of catastrophe bonds. These were originally designed back in the 90s to cover natural catastrophes, hurricanes and earthquakes, but they've been fundamentally re-engineered. Today, they are purely sovereign financial survival instruments. Think about it. If a nation defaults, the private investors holding these bonds lose their entire principal, and that capital is instantly transferred to the reinsurer to cover the sovereign losses. When this is tied to climate-resilient debt clauses, the mechanism enforces a mandatory payment holiday, essentially keeping the sovereign state on financial life support. Which brings us to File 5, the ultimate moral hazard. As we analyze this flawless mathematical armor, we really must confront the geopolitical fallout. The implementation of this architecture has created a terrifying shift in global power dynamics. We call this the ultimate moral hazard, because when an invisible, private institutional backstop exists, it fundamentally alters the behavior of sovereign politicians. Knowing that their absolute failure will trigger an automated bailout from the capital markets, well, it encourages dangerously reckless national spending. The safety net perversely incentivizes the very fiscal irresponsibility it was designed to protect against in the first place. Examine this regulatory framework detailing credit reinsurers. It absolutely proves their structural role during severe economic crises. Unlike highly volatile credit funds, reinsurers actually remain committed to established lines throughout multi-year loss cycles. They are the ultimate hold-to-maturity backstop. They absorb the shockwaves of massive economic turmoil without retreating. Their unseen presence is quite literally the foundation of global financial stability.
But as you might guess, this stability comes at a chilling cost. We are currently witnessing the era of sovereign de-risking. Because reinsurers hold the keys to a nation's financial survival, they now possess the immense power to dictate national policy. The mere threat of withdrawing default protection forces governments to slash public spending and liquidate assets. Furthermore, elite AI predictive modeling allows these reinsurers to forecast fiscal crises months in advance. The models dictate the capital flow. This means unprofitable developing nations are structurally abandoned by the private safety net long before a crisis even hits the mainstream news. The tail is now unequivocally wagging the dog.
We leave you with this lingering reality. In this explainer, we've mapped the hidden architecture of the insurance underworld. We've seen the parametric triggers, the synthetic risk transfers, and the AI models that dictate sovereign survival. But the critical question remains, is this invisible layer of reinsurance protection truly a robust, impenetrable shield for the global economy? Or is it a highly calibrated, ticking time bomb of unmanageable systemic risk, just waiting for the one mathematical anomaly it cannot absorb?